today. And yep, hopefully over the next 2 hours, I can provide you insights to how to deal with the upcoming questions for the Singapore Foundation Program module. So just as a brief recap, right, on the last session on Wednesday, we actually went through the individual tax question and part of the corporate tax question. So I hope everyone can see my screen. If it's a little bit small, let me try and make it bigger. Okay, so for those of you who this is your first class, you might not know, we went through some questions last week. And if my memory does not fail me, I think we finished up this question. So the next one we should be doing is question 38. But if for those of you who attended my class on Wednesday, if this is not correct, feel free to let me know. I'm getting a little bit confused these days with the questions and classes that I'm teaching. Okay, if this is the correct one, maybe let me just continue with this. So for today, the intent is to go through the rest of the corporate tax questions, and then subsequently we'll go into the GST and other topics. So I foresee that we may have some time today. So maybe during the session or after this, if you have any specific question in relation to upcoming exam, or any areas in corporate tax, GST, or individual tax, feel free to let me know. All right. So without further delay, let me start with the question 38 on the screen. So on question 38, we have RMS Private Limited wrote off damage inventory of 100,000 in its account in YA 2024 due to a traffic accident during delivery. As there was initially insufficient evidence to substantiate the loss, no tax deduction was claimed for this loss in YA 2024. Subsequently, in YA 2025, RMS Private Limited receives a 100,000 insurance payout and is now able to obtain full supporting documentation for the loss. Which statement best describes how the insurance payout and the possible deduction for the loss should be treated for Singapore tax purposes? A. RMS Private Limited may seek to revise its YA 2024 tax computation to claim the 100,000 deduction since the supporting documentation is now available. If the deduction is successfully claimed, the 100,000 insurance proceeds must be brought to tax as income in YA 2025. B. RMS Private Limited must tax the insurance proceeds in YA 2025 regardless of whether it claims or is allowed a deduction in YA 2024 for the loss. C. The 100,000 insurance proceeds are not taxable in YA 2025 because no deduction was claimed in YA 2024. D. RMS Private Limited is not required to report the insurance proceeds for tax purposes in YA 2025. So out of these four possible options, the standard answer given is the first one. Okay, so before I go in and explain why this is the best answer possible, let me go through with you what's the concept in relation to insurance payouts and deductions. So I'm sure that as you revise through corporate tax, you realize that there are certain situations where the IRS will give a deduction because of, I would say, unexpected circumstances faced by the taxpayer. A common example will be bad debt expense deduction. So as you know, as a company operates, generally it may accumulate bad debt expense. And why is this a problem? Because when you actually bring the income to tax, the revenue is recognized on an accrued basis. It's not on a receipt or remittance basis. I think this is a very important technical point that you need to understand. So because the income is taxed on an accrued basis, at the time that the income is brought to tax, right, the customer may or may not have paid the company. So sometimes the company may be selling to customers on the 90 days credit term, 120 days credit term. This is very common in today's industry, right? Where for major customers of some companies, they are allowed credit terms before they're required to pay. So of course, because of this credit term issue and not cash on delivery, there are situations where the customers, for one reason or the other, will not be able to pay the invoice. Okay, as a result, the company suffer bad debt and book a bad debt expense in the books. So from a CIT perspective, right, you will actually claim a deduction on the bad debt expense subject to conditions. They think like, okay, the debt must have turned bad, it must be more than 12 months, etc. But the important concept here is if you claim a deduction on bad debt expense, if subsequently during liquidation or winding up, you manage to get, okay, then the recovery of the debt previously written off should be a taxable proceed. Okay. So this principle can be applied across all type of recovery. So what I want you to get out of this question, most important is that technically the concept is that you actually incur a loss, right? And you claim a deduction against it. Subsequently, when you recover it, the proceed will be taxable. Okay. So it's like kind of I would say it's a logical principle. If you claim a deduction against a loss and you recover against that loss, the recovery must be taxed, right? So on the basis itself, if the flip side is true, you incur a loss, you didn't claim a deduction, right? Then technically, if you subsequently recover it, you could say that it's a non-taxable proceed. Okay. So on this principle point, is that very clear? So if you then look at the four possible options, based on what we have just discussed, B and D would be inaccurate for sure. B says RMS Private Limited must tax the insurance proceeds in YA 2025, regardless, right, of whether it claims or is allowed a deduction of YA 2024 loss. So this is technically incorrect. So if the IRS didn't allow for a loss deduction in 2024, in theory, you don't actually have to tax the amount in 2025, right? D says RMS Private is not required to report the insurance proceeds for tax purposes in YA 2025. Now, this is a wrong statement because it does not comment about the taxability. You can't actually just eliminate this recovery from your account, right? I believe all of you are accounting students here. When you have recovery like this, it's usually booked as other income. So how do you not report insurance proceeds for tax purposes? So that's incorrect. But rather, when you present a tax computation, you could do a tax adjustment to see if it's capital or revenue or is it subject to tax or not. So the more correct answer to frame D is DMS Private Limited is not required to bring the insurance proceed to tax. Okay, then we look at A and C. So A, as is highlighted, that's the recommended or model correct answer. But there are candidates who ask me, why is C not possible? So let's look at C. C says the 100,000 insurance proceeds are not taxable in YA 2025 because no deduction was claimed in YA 2024. It's actually true. This is a possible option. So between A and C, A is the correct technical answer. That is the expectation that you do it. But practically, if you tell me that, today this is a real life situation. You're handling your clients or your company's tax return, right? Because the answer A involves going back to revise your YA 2024 tax return and then to do a filing, right? And then subsequently you bring it to tax in this year. So there's actually more administrative requirement. I'm going to implement administrative procedure involved. So the practical approach, right, would be that C is also a possible correct answer because if you did not claim a deduction in the earlier YA, you should not be taxable in the current YA. But if the question is asking you which best describe, which means which is the correct academic answer, then the answer is A. Income. Can anybody hear me? Did I just jump off and on again? Okay, never mind. So let's continue. KBC Private Limited, a Singapore incorporated company, provided the following reimbursement during the financial year 2024. Employee travel expense from home to office, 22,000. CEO's mileage on his own private car in Singapore to travel from office to meet clients. From a corporate. Okay.
The recording has stopped.
Hi, Guo Feng. I think your voice is breaking up. Hi, Guo Feng. Can you hear me? Okay, I think he's logging in again. Okay, just wait for him to log in again. Before you try to speak, let me just see whether is it breaking up.
Okay. Hi, Laksha. Can you hear me properly? Is everything good?
Yes, now everything is okay. Okay, I resume the recording.
Okay. Is there a break somewhere? Do I need to go through this question again? Because I'm not sure when you guys lost me or what happened.
Okay, I think it was just breaking up for question 39.
Okay, maybe I'll just go through the whole question again then.
Sure. Okay, I'm going to do the recording.
Sure. Okay, sorry everyone. So back to question 39.
This
KBC
meeting is
Private
being
Limited,
recorded.
a Singapore incorporated company, provided the following reimbursement during the financial year 2024. Employee travel expense from home to office, 22,000. CEO's mileage on his own private car in Singapore to travel from office to meet clients, 10,000. CEO's mileage on his rented car in Malaysia for business matters, 7,000. Question is, how much of the above will be tax deductible in KBC Private Limited's YA 2025 tax computation? So when we look at this question, it is very important to discern who is the question asking about. The question is not asking about the deductibility or taxability in the hands of the CEO or employee. It's focused on the company, right? So if we're looking at a company, the deduction is governed under Section 14(1) and Section 15 of the Income Tax Act. So Section 14(1) requires the expense to be incurred wholly and exclusively in the production of taxable income and must be revenue in nature. Specifically, it's also not an expense to be prohibited by Section 15. So keeping that in mind, we look at the three expenses. One, employee travel expenses from home to office, 22,000. So this is not related to business because it is basically the expense for the employee's commuting costs, right? So if you're talking about deduction, or if I want to make it a deduction, if this is given to the employee as a travel allowance, then yes, this is employee benefit is deductible. But because it is a reimbursement, right, for employees' travel expense from home to office, which is basically commuting to work, is considered non-deductible from a tax perspective. Next, CEO's mileage in his own private car in Singapore to travel from office to meet clients, 10,000. This is not commuting, right? This is basically business meetings. So in theory, this should be an amount that is deductible. However, if you look at Section 15 of the Income Tax Act, it prohibits deduction on any expenses incurred in association with an S-plate car. And given that this is a private car, it's likely an S-plate car in Singapore, therefore deduction not allowed. Last but not least, CEO's mileage has rented car in Malaysia for business matters of 7,000. So this restriction for S-plate car is only exists in the Singapore vehicle because in other countries there is no concept of an S-plate vehicle. So if you're talking about overseas vehicle expenses, right, it is actually deductible. So 7,000 is the only one is deductible because it's incurred wholly and exclusively in the production of taxable income, revenue in nature, and is not prohibited by Section 15. So the correct answer here is 1. Any question? Nope. Okay, good. Now let me move on because we have just finished corporate tax. And I will now move on to the next one, which is GST. Okay, let me see how to make it bigger for everyone. Okay, so now this is an interesting question, right? On 1st April 2022, Peter Michael Angelo Incorporated Cannery Private Limited (CPL) in Singapore. CPL is a Singapore tax resident company and its financial year end is March. CPL incurred the following startup costs prior to CPL's receipt of the first dollar of revenue on 15 April 2023. So the first question, these are the list of expenses that's incurred prior to CPL's receipt of first dollar of revenue. So we can all call them what? Pre-commencement expenses. First one, business registration fee with ACRA, $315. Legal advice and company secretarial fees for company setup, 25,000. Website hosting / website design and setup, domain registration, company email setup, etc., 33,000 with further breakdown in note 1. Pre-launch roadshow overseas in March 2023 with a note 2 of 18,000. IP registration fee associated with business trademark, watermark, etc., paid on 2nd April 2023. Note 1 reads, cost incurred associated with new business design by a third party was 21,000. The remaining 12,000 relates to website maintenance costs. Note 2, the expense relates to business development events to showcase CPL's products and services. Question 28. Given the facts above, which of the following statement is or are correct? CPL is eligible for partial tax exemption of 102,500 in YA 2025 if its chargeable income for YA 2025 exceeds 150. Let me see. Leadership value. Okay. 2. CPL may be eligible for Enterprise Innovation Scheme if it incurs approved R&D, IP registration, or innovation project expense. 3. Expense incurred for CPL's pre-launch overseas roadshow are not deductible for tax purposes. 4. CPL will not qualify for startup tax exemption if it was incorporated shortly after winding down a sole proprietorship with similar business activities, even if the ownership structure has changed. So to address these 4, you need to understand briefly what is this startup exemption and what kind of expenses are deductible. So let's look at them one by one. First one, CPL is eligible for partial tax exemption of 102,500 in YA 2025 if its chargeable income for the year exceeds 150,000. Well, this is not correct. This would be correct if CPL is not eligible for startup tax exemption. So as we look at CPL, right, it's basically formed by 3 shareholders. So 3 individual shareholders, sorry. On this basis, I don't see why it can't actually qualify for startup tax exemption. So if you're qualifying for startup tax exemption, you would not be claiming partial tax exemption. So the first statement is not correct. 2, you may be eligible for Enterprise Innovation Scheme if it incurs approved R&D, IP registration, or innovation project expense. And this is correct because if the company incur the qualifying expense under the Enterprise Innovation Scheme, they should be able to get a deduction. 3, expense incurred for CPL's pre-launch overseas roadshow are not deductible for tax purposes. This is incorrect because it actually earned $1 of income, and clearly the roadshow has a business link. It should be seen as incurred wholly and exclusively in the production of taxable income, and definitely roadshow sounds like expense as revenue in nature. Therefore, it should be deductible. Last but not least, CPL will not qualify for startup tax exemption if it was incorporated shortly after winding down a sole proprietorship with similar activities, even if the ownership structure has changed. So I think this is the part that is a little bit confusing, mainly because why would the purpose of incorporating a company impact its eligibility to startup tax exemption? So from a criteria perspective, the startup tax exemption will apply if the company only has 20 or less individual shareholders, and also if there's a corporate shareholder, it is under the prescribed holding percentage. There's nothing to say that just because the company is incorporated after winding down a sole proprietorship structure, you cannot claim startup tax exemption. The only remote part is true is unless the question says that the sole purpose of doing this is avoid paying tax, which will lead then to anti-avoidance and tax evasion situation. But given that startup tax exemption is something that's given to everybody as long as you meet the criteria, I don't see why it will be a tax evasion. So as a result, sentence 4 or statement 4 is also inaccurate. So the only correct statement here is number 2. Any question? Next, what's the total amount of deductible pre-commencement expense that CPL can claim in its YA 2025 tax computation, assuming that CPL is a trading company? So the prescribed answer is 48,000, and let's look at how they come up with 48,000. So here I think we can see, right, out of the total amount here, what would be accurate is that you would consider whether or not each of these will be deductible. The clearly deductible one is the pre-launch roadshow of 18,000. That is definitely deductible. And in terms of the third-party design as well as the website, you need to further break it down into more granular details to see if it's deductible. So in general, right, if website hosting and design setup, if these are not considered capital in nature, you should be able to claim the 33,000. If otherwise, you would not be able to do it. So in total, that would be 51,000. I think 48,000 is more a typo. Okay. The rest, such as IP registration fee, legal advice, and corporate secretarial fee for company setup and business registration, are considered capital in nature. Any questions here? Just a sec. I think I see some chat. Okay, no, all good. Okay. So next, 40 to 42. Okay, for 40 to 42, this is a situation talking about unabsorbed losses. So on January 1, 2023, Falcon acquired a 75% stake in Pelican Private Limited. Both Falcon and Pelican are incorporated in Singapore with financial year end of 31st December. Both companies must maintain the same business activities, and there is no change in shareholdings after the acquisition. Falcon and Pelican reported the following tax position in the respective year of assessment. For Falcon, YA 2023, YA 2024, and YA 2025. So the situation is that Falcon has assessable income in 23, end up in a loss position in 24, and have assessable income again in YA 2025. For Pelican, 23, it has a loss. 24, there is unabsorbed capital allowance. In 25, there's unabsorbed loss of 100,000. In other words, right, in all the 3 years for Pelican, it's consistently in a loss position. It's either unabsorbed losses or unabsorbed capital allowance. So question 40. Which of the following statements are incorrect with respect to the most optimal outcome for Falcon and Pelican in applying the rules for group relief, loss carryback or forward as applicable? 1. Falcon and Pelican can only apply group relief for YA 2023 if Falcon had acquired the 75% stake in Pelican on 1 Jan 2023 and owned the 75% stake throughout the whole of financial year 2025. 2, it is preferred to first carry back loss items to improve Falcon's cash flow position where all carryback conditions are met. 3, Pelican can transfer its unabsorbed capital allowance in YA 2024 to Falcon in computing Falcon's assessable income. Okay, so what do you think? So for number 1, yep, it's definitely correct, because if you have at least 75% on the 1st Jan 2023 and maintain throughout, you will be members of the same group. So you can apply for group relief. Is that true or false? Can someone tell me? Do they have to maintain from 1st Jan 2023 if it's for YA 2023? YA 2023 is FY 2022, right? So clearly, there is something wrong here. The YA is wrong. Okay. Next, it is preferred to carry back loss items to improve Falcon's cash position where all carryback conditions are met. So if we look at Falcon, Falcon has a loss in YA 2024. So that's the only thing that can be carried back, because YA 2025 has no loss. So theoretically, it is true, but if you ask me, whether you want to do it is optional. Loss carryback is not a compulsory adjustment. Okay, so while it is preferred just because you get more cash, but if you decide not to do it because of administrative logistical challenges, that's also fine. But this is at least a correct statement. So last but not least, Pelican can transfer unabsorbed capital allowance in YA 2024 to Falcon in computing Falcon's assessable income. So this statement is not an issue of whether or not, right? There is the conditions are met. YA 2024, Falcon is in an unabsorbed loss of 300,000. So if it's already in an unabsorbed loss position, why would there be a need to transfer unabsorbed capital allowance from Pelican to Falcon? So this statement is incorrect because I don't even need to talk about the conditions yet. If we end up in a situation where both parties are in a loss position, there is really no need to transfer the loss items, because the transferred loss items cannot be carried forward or carried back, right? So therefore, for the whole of YA 2024, given that both of them are in a loss, one ending up with unabsorbed capital allowance, the other with unabsorbed trade losses, there shouldn't be any transfer at all. Therefore, statement 1 and 3 are incorrect. Any question? Nope. Okay, 42. In YA 2026, Pelican's assessable income is 50,000. Assuming there is no change in Pelican's business and there was no group relief or loss carryback for the unabsorbed loss and capital allowance from YA 2023 to YA 2025, what are the relevant dates to consider for the purpose of utilizing the unabsorbed loss / capital allowance to reduce Pelican's YA 2026 assessable income? Okay, so this is a very interesting question because honestly, I would say that perhaps Pelican would have any unabsorbed capital allowance or losses left. Okay, so the question says, even if you have no change in your business, okay, and no change in relationship shareholding, there's no change in shareholding. So you're talking about the relevant dates for considering unabsorbed loss / capital allowance. Okay, so I would treat this as only for unabsorbed loss in YA 2025. Okay, so for this one, for YA 2025, it will actually be on the last day of the year that the loss have been incurred versus the first day of the year that you seek to claim. And therefore, the dates will be 31 December 2024 / 1st Jan 2026. Any question? Nope. Okay. So moving along. Question 43. For group relief purposes, the order of transfer with respect to loss item is first, current year unutilized capital allowance, second, current year unutilized trade losses, third, immediate preceding year unutilized trade losses. B, first is the current year unutilized capital allowance, second, current year unutilized trade losses, third, current year unutilized approved donations. C, first is current year unutilized trade losses. Second is current year unutilized capital allowances. D, first year is current year unutilized capital allowance. Second, current year unutilized approved donation. Third, current year unutilized trade losses. So first of all, right, you need to understand that for group relief purposes, you can never transfer any preceding year loss items. Okay, so that is the first rule of thumb you need to remember. If I'm performing group relief, I will only consider current year loss items. Anything in the preceding years are all not eligible. Okay, so that immediately eliminate option A, because option A says you can transfer immediate preceding year unutilized trade losses. So that is incorrect. When we do group relief, we only look at current. Okay, so the correct sequence will be current year capital allowance, trade losses, and then donation. And this sequence must be strictly adhered to. Meaning, if you end up in a situation where the company incur these three types of losses, and you want to elect, says, oh, I don't want to transfer my unutilized capital allowance, I just want to do trade losses, that is not possible under the law. You have to do it in this particular sequence. You have to first exhaust your unutilized capital allowance, then go to trade losses, and then to approve donations. Okay. The C and D is incorrect because C missed out donations, I believe, and trade losses is put ahead of capital allowance. And for D, your capital allowance is correct, but they swapped donations and trade losses. So it's incorrect too. Any question here? No? Okay, question 44. A company is considering acquiring an existing industrial building in Jurong that was first used over 50 years ago. What type of capital allowance can the company claim for the cost of acquiring the building? A, land intensification allowance. B, industrial building allowance. C, the company is not eligible to claim any capital allowance on the cost of the building. D, the company may be eligible to claim either LIA or IBA at its discretion. Okay. So the correct answer is highlighted as C. The company is not eligible to claim any capital allowance on the cost of the building. So if you look back, right, IBA or industrial building allowance is an old concept that has since been phased out for years. So what is essentially industrial building allowance is a basically capital allowance on the acquisition cost of the building. So in the past, the IRAS used to grant this especially for manufacturing sector. Companies who are heavily engaged in manufacturing will acquire those buildings in the production of the taxable income. So since the pivot that Singapore has made to become a high value economy, the IRAS has also phased out IBA and replaced it with land intensification allowance, LIA, where similar to IBA, is a deduction on acquisition cost, but is granted to buildings that qualify for more, I would say, productivity activities. That's why it's called land intensification allowance. There is a certain ratio or plot ratio, productivity ratio to be met. So in this case, you look at the question, the company is going to buy an existing industrial building, right? It means they are not the first owner. They're just going to buy over from another company and has been first used 50 years ago. So based on the question today, when you acquire this industrial building, you cannot claim anything. There's no capital allowance for building. But when the other company that acquired 50 years ago, assuming that he or she has started the claim when IBA was in existence, he can continue to claim until his entire IBA is finished. Okay, so you need to make a distinction. There could be companies today that are still claiming IBA, and that's because the IBA claim they are making is in respect of buildings that were acquired before the regime is phased out. So for those companies, they can actually carry on until one day, such like this, when they sell, the buyer will no longer claim any IBA, or when they decide to liquidate the company, and that will terminate the IBA. Okay, so the correct answer here is C, not eligible to claim any capital allowance on the cost of the building. Any question? Next.
Tessie, sorry to interrupt.
Yes.
In what
Coming.
scenario will we use LIA?
So LIA, you will be using it in a very interesting sector. So those that I have seen in Singapore is like data center. So it will be only when you are acquiring this, I would say, buildings that is, how should I say? Because they need to satisfy a certain kind of ratio, okay? And then you can claim the LIA. So it has to be a very, very specific kind of structure, and you have to get approval. So the things to note is you need to actually have approval from EDB. You get where I'm coming from?
Fessie, no. Maybe you would like to
Okay.
explain further, yeah.
So okay, let's say today I'm buying a building. Okay. So in the past, the industrial building allowance is very straightforward. If I am buying towards a building that's used for my manufacturing, I can claim industrial building allowance. Okay. When they phase out IBA and they introduce LIA, okay, the reason is that the government wants to encourage the pivot from low value manufacturing activity, okay, to high value ones. Okay, they want to control effectively what will be the type of buildings that are being used by businesses in Singapore. Okay, so as a result, what they've done is they actually introduce this LIA that is administered by the Singapore EDB and Building Construction Authority, BCA. So today, if a company wants to claim LIA, they have to make an application and ensure that the building that they have actually satisfy the criteria that the government has set out. So what would be the criteria be? It's actually very technical. For land intensification allowance, you have to actually satisfy things like gross plot ratio. It's not a tax kind of ratio. It's more like a land and building use. So what they talk about is things like the zoning. What is it zoned for? Okay, what is the gross plot ratio (GPR)? So all these conditions are the conditions that the company need to satisfy before they can claim the LIA. And unlike IBA, LIA is something that you need pre-approval. Meaning today, if I want to claim LIA, I cannot just say I qualify. I have to either write into EDB or BCA, depending on the industry I'm in, to seek approval for use of LIA. So that would be a situation of how LIA is actually implemented and claimed. Is that clear?
Sort of. Fessie, but I just want to ask for exam, right? Usually for A question, they will only ask us like this kind of question or
Okay, so in the past, I have not seen the questions testing on the criteria. But if you look at this year's examination format, right, it has been revamped to MCQ. So it is going to be very unlikely they are going to test you in the MCQ. I mean, I don't rule it out, but if I think of the examination structure, it's going to be very unlikely you're going to test you on whether or not this qualifies for LIA. So what I would suggest you revise is you need to be familiar with, let's say, right, the question says the company has obtained approval from EDB to claim LIA, or the question may not have the EDB's approval to claim LIA. Then you need to figure out, okay, if it's not approved, what you should say that no LIA because it's not approved. If there's approval, then yes, you can proceed to claim LIA. And how LIA is calculated is basically initial allowance or annual allowance. Initial allowance of 25%, and if annual allowance of 5% on a going basis. That would be the kind of question I think will come up. Because if not, it's going to be quite difficult for them to test you something that is going to be approved, right? Because even if you assess the criteria that you satisfy, you can't claim it until it's approved specifically by either EDB or BCA. So it's kind of like a tax incentive question.
Okay, thanks, Bessie.
No problem. Wait, is there any other questions there? Nope. Okay. Moving on. Question 45. Which of the following statements about Singapore General Partnership is is incorrect? A. The partnership must file an annual income tax return. B. When filing the annual income tax return, the partner must calculate its tax at a flat rate of 17%. C. The income of the partnership is passed through and taxed in the hands of its individual partners or corporate partners according to their agreed upon profit sharing percentage. D. If there's a change in partnership composition during the year, the income of the partnership must be apportioned based on the profit sharing ratios before and after the change. Okay, the correct answer is of course B. The incorrect statement is B, so that's the correct answer. Now, first statement, why do you think that this is correct or wrong? There are people who tell me that actually it's wrong, but I would say that, okay, they filed a return. I wouldn't call it an income tax return, but a partnership must file an annual form known as Form P. So the purpose of Form P is not to actually determine how much tax the partners pay. Okay, the purpose of Form P is to inform the IRAS what is the overall taxable position or overall loss suffered by the partnership and the attribution to each of the partners. So the correct statement is the partnership must file an annual return, right? And that's true. Okay. So the second statement is wrong because when you file an annual tax return, you file the annual statement, you must calculate its tax at flat rate of 17%. Like I mentioned earlier, the annual return doesn't compute any tax. And even it does, it cannot compute as a flat rate of 17% because it's dependent on each individual partners. And when they go to an individual, you can't even assess how much tax payable because the partnership income may be one of the income that the individual or the company gets, right? If he has other business losses, he could possibly offset against that income. So statement B that says you must calculate tax is incorrect. C is correct because income of a partnership is not taxed at the partnership level, as partnership is not a separate legal entity. It has to be split in accordance to the profit sharing ratio. D is also correct. If you change your partnership composition, then you need to actually attribute the profit before and after the change and based on the relevant ratio accordingly. So for example, if me and Laksha form a partnership 50-50, right? And in January to June, that's our arrangement. Suddenly in July, somebody comes in and is now 40-30-30. Then when I'm reporting my profit sharing, I need to ensure that I report during Jan to June is between me and Laksha as two partners, each 50-50. Come from June to December, there's now three partners with different ratio, 30-30-40, and then the profit share changes accordingly. Okay, so because of the nature of a partnership, you need to actually do the split when you are attributing the profit share. Any questions? Nope. Okay. Question 46. Consider the following statement. 1. A partnership can itself carry forward tax losses to offset against future profits of the partnership. 2. Each partner may carry forward their shares of the partnership losses to offset their future income subject to prevailing tax rules. 3. Partnership losses are forfeited if not fully utilized in the year incurred. 4. Only a managing partner is entitled to claim the partnership's share of tax losses. Which of the above statements is/are incorrect? Okay. So as mentioned earlier, anything to suggest that a partnership is paying taxes will be incorrect. Okay. So first statement says you can carry forward tax losses to offset against future profits. That doesn't make sense because you're not actually taxing the partnership. So the tax losses or any kind of loss at the partnership level every year will be shared in the same profit sharing ratio between the partners. So you can think about it as a partnership is an agreement, right? At the end of the year, whether is it losses or whether is it profit, what happens is it has to be distributed to the partners. So you don't carry forward anything. Okay. Now, statement 2 is correct because as a partner itself, you can be a corporation, you can be an individual. There is no restriction that partnership must be all individuals. There could be corporates in the partnership. And then what happens is that when you actually attribute these losses to the individuals and corporates, it becomes unutilized or current year unutilized partnership/trade losses and is subject to the carry forward rules. So for example, if these are considered partnership trade losses in future, you will treat them as unutilized trade losses and subject to the relevant shareholding test for the company when you seek to utilize in future. So statement 2 is correct. Statement 3 says partnership losses are forfeited if not fully utilized the year incurred. This is not true because again, the partnership losses are being split among the partners in the agreed ratio. Nothing is forfeited, not unless the partners decide to fold. Last but not least, only a managing partner is entitled to claim the share of tax losses. Again, that's not true. The main purpose of a managing partner, right, is to be appointed is really more for administrative and for the IRAS to go to a POC in the event there's non-compliance. So for example, if you are named as the managing partner, then you need to be responsible for filing the Form P. If you don't, IRAS will come after you. Okay, any questions? No. Hey, question 47. Which of the following aligns with the arm's length principle under Singapore transfer pricing law? A. IRA set up a prescribed set of prices for all related party transactions to ensure compliance. B. Related party may set any prices as long as there's no appeals of tax revenue. C. When executing any related party transactions, the transfer price must fall within an acceptable range that's comparable with a transaction that's entered into with an unrelated party. D. Transfer pricing applies only to transactions below market value. So these are 4 very interesting statements, right? So before I go in deep of them, I want to ask how many of you understand transfer pricing? Anybody can tell me what's transfer pricing? Anybody deals with it? Okay, so let me briefly give you a background to transfer pricing. Okay, so transfer pricing is a terminology that is commonly used in, especially in the very, I would say harmonized, but it's a very globalized world today. So transfer pricing refers to the requirement to adhere with the arm's length principle when 2 related parties are transacting with each other. Okay, so if you ask me, what's the definition of related party? It's not found in the Income Tax Act. Comb through the Income Tax Act, there's no definition of related party. And there's no need to, because I presume all of you, like I said, are accounting students. You would know that from an audited financial perspective, you need to disclose all your transactions with your related parties. Therefore, from a tax angle, we follow accounting definition. If accounting defines this transaction as transaction related party, those will be considered related party transactions for tax purposes. So the requirement under the arm's length principle is to ensure that the transfer price between related parties for goods or services is within reasonable range of a transaction it does with a third party. Okay, so for example, if you are selling a laptop to a third party for 1,500, that's the market value, you can't turn around to sell the same thing to your sister for $1, right? Even if you sell for $1, you say you make a loss, but because your sister and you are related party, the IRAS will definitely pursue the fact that you are not transacting this at arm's length. Okay, so now with this high level transfer pricing knowledge, let's look at the 4 statements and figure out which one aligns with the arm's length principle. A, you set out a prescribed set of price for all related party transactions. So this is going to be a big administrative nightmare. Try imagine if IRAS have to figure out what are the possible transactions today in the entire of Singapore and set up for each transaction a prescribed set of prices for companies to follow. I think IRAS will need to hire at least 100 times more people. So this is not correct. They don't prescribe a set of price. The arm's length principle never seeks to prescribe a set of price, but rather it requires you to ensure your transaction with related party is reasonable and within the range of your transaction with the party. Okay. B, you may set any price as long as there's no abuse of tax revenue. I think the focus on price is never abuse of tax revenue, and it's not a principle. Abuse of tax revenue will fall under a general anti-avoidance legislation, not under the arm's length principle. So C is correct. The transfer price will fall within an acceptable range, comparable with a transaction entered into with unrelated party. And D, transfer pricing applies only to transactions below market value. This is incorrect. Transfer pricing only applies to related party transactions and requires the transaction to be within an acceptable range that is not either above or below market value. So the last statement is incorrect. Any questions? No? Okay, moving on. Question 48. Which of the following statements best describes the relationship between prohibited expenses under Section 15 of the Singapore Income Tax Act and block input GST claims under Regulation 26 and 27 of the GST General Regulations? So the question clearly states that you are looking at 2 legislation, Section 15 of the Singapore Income Tax Act that prohibits tax deduction, as well as GST claims under Regulation 26 and 27, which determine what are block input GST. Okay, statement 1. If an expense fails the wholly and exclusively test for income tax deduction, it is automatically disqualified under Regulation 26 and 27 for the purpose of an input GST claim. 2. Expenses related to certain staff or family benefits may be blocked from input GST claims, even if those expenses are deductible for income tax purposes. 3. GST input tax claims may be allowed in respect of expenses that are prohibited as a deduction under Section 15. If there is no direct connection to the taxable business activity and the item is not listed under the block input GST regulations. 4. A successfully applied close nexus test override the block input GST regulations for staff family benefits and club subscriptions. 5. Not all Section 15 prohibited expenses are automatically blocked for GST purposes. IRAS administrative concessions and the close nexus test create exceptions where genuine business connections can be demonstrated. Okay. Now the correct answer, of course, is 2, 3, and 5. So let's look at 1 and 4 first. Why are they inaccurate? So first of all, right, there is nothing to link income tax deduction and block input credit. So statement 1 fails because you're saying that if my expense fails wholly and exclusive test for income tax deduction, it automatically becomes block. And that's incorrect. So you can think about section 15 and the regulation 26 and 27 as two different lists. One list solely for income tax purposes, one list solely for GST purposes. I do not rule out that there are certain items on the two lists overlaps. A common one will be private car expenses. Okay, but that doesn't mean that it will be dependent. Okay, so in fact, these two lists are independent. You have to assess them independently. Therefore, statement 1 is incorrect. Statement 4 is incorrect because if an input GST is blocked under regulation 26 and 27, it is blocked. You cannot suddenly override it. Similar to how if the expense is blocked by section 15, like private car, okay, you could argue that it satisfies section 14.1, is incurred wholly exclusively in the production of taxable income, it is actually revenue in nature. Still, if it's blocked by section 15, it is blocked. Okay, the legislative language or the regulation is absolute. So you can't use a closed nexus test to override block input credits that's blocked under regulation 26 and 27. It doesn't work that way. Okay, so now we rule that 1 and 4 are wrong. Let's look at why 2, 3, and 5 are correct. So 2 says that expense related to certain staff or family benefits may be blocked for input GST, even though they are deductible for income tax purposes. It's correct, precisely, because these are two tests, right? When you look at the expense from an income tax perspective, you look at section 14.1 and section 15. If it's not blocked, if it qualifies under section 14.1 and does not block under section 15, you can claim a deduction from an income tax perspective. But for input GST, you apply the GST regulation 26 and 27. Therefore, you could have two different outcomes from a GST input tax perspective and a corporate tax deduction perspective. It is not something that's surprising. Okay. Next, GST input tax claims may be allowed in respect of expenses that are prohibited as a deduction under section 15. Again, it's the same thing, right? Because even if an expense is prohibited as an income tax deduction under section 15, it doesn't mean that you automatically lose the input tax credit. You still need to look at regulation 26 and 27. Okay. Last but not least, again, it's the same thing. It says that not all section 15 prohibited expenses are automatically blocked for GST purposes. You could look at regulation 26, 27, the administrative transaction and closed nexus test to see if input GST can be claimed. In other words, you do not apply this by commingling them. They are very separate legislations. Okay, any question on this one? Nope. All right, section 49 to 50. Consider the following scenario. Swing Sparrow Private Limited, SSPL, operates a golf pro shop that specializes in high-end golf equipment, apparel and accessories, and related services such as golf coaching, golf club fitting, and repairs, etc. SSPL incurs the following expenses, exclusive of GST in Q3 2025. Office pantry and soft drink for staff, 2,000. Monthly subscription fees at a local indoor golf simulation center for staff, 3,000. Golf course green fees incurred for employees, family members at family golf day event, 4,000. Additional information, SSPL's financial year end is 31st December. SSPL's annual turnover in 2024 was 2.16 million. Question 49. Which of the following statements are correct with respect to SSPL's eligibility to claim input GST? 1. The closed nexus test applies in the case of the input GST for office pantry snacks and soft drinks for staff. 2. Input GST incurred on golf course green fees are blocked under Regulation 26 and 27 as it relates to benefits provided to the employee's family members. 3. Block GST does not apply if snacks and drinks are offered to customers. 4, an administrative concession is available to claim input GST with respect to club membership fees incurred for the benefits of employees. So the correct answer is, of course, 2 and 3. And let's look at why is it wrong for 1 and 4. First, for office pantry snacks and soft drink for staff, there is no need to apply the closed nexus test because clearly this is something that you should be able to claim input GST. Okay, and on the flip side, number 4, there is no administrative concession to claim input GST with respect to club membership fee because club membership fee has been explicitly blocked under Regulation 26 and 27. So 1 and 4 is incorrect. Now 2 and 3 is correct. And let's say 2 and 3. So when you actually incur the fee, the cost green fees for the family members of the employees, note it's not for the employees, because it's employees' family members, the input GST is considered blocked under 26 and 27. 3, block GST does not apply if snacks and drinks are offered to customers. That's correct, because if you're incurring GST on pantry drinks or food that's given to your customers, it should be considered as claimable input credit. So 3 is definitely correct. Correct answer, 2 and 3. Okay, and based on the facts above, calculate the input claimable GST for SSPL, and the correct answer is 450. So let's go up. Okay, I think we can come to a conclusion of why it's 450. So basically, these amounts are exclusive of GST. You need to be very careful. Singapore GST rate, I hope everybody knows, is 9%. So first one is claimable. 9% of 2,000 give you $180. Second, monthly subscription fee for staff. Yes, 3,000 times 9%, 270. Third one, we all agree is blocked, so no calculation. 180 plus 270, that will give you 450. That's the amount here. Okay, any questions so far? Okay, good. If that's the case, we are slightly at a 1 hour mark. Let's take a 15 minutes break. Right. In the meantime, if there's any specific topic or questions you have, feel free to put it in the chat. I will address it after the break. So if there is no specific areas that you would like to ask or questions, what I'll do is I'll go through the general revision in all three areas: individual tax, corporate tax, and GST. But of course, if there is a particular interest in a certain topic or area that you would like me to go through, I'm more than happy to cover them. So feel free to put it in the chat so that we can have a meaningful revision after this. We should have roughly around 30 minutes left for revision after we come back from the break. Okay, if not, I'll see you back at 8:50. Thank you, everyone.
The recording has stopped.
Okay, I'm not sure what's going on. Okay, so let's continue
This
back.
meeting is being recorded.
Okay, so the first question I have is by Ming Yao to say, is the reason for one not because the pantry supplies are allowed as an admin concession under the fringe benefit ETG? So for that purposes, let's look at this e-tax guide, I presume you're talking about on fringe benefit. So there are several components that's covered in this e-tax guide, right? One, in terms of input tax recovery, it talks about a concession where you can actually claim the credit despite the fact that the tax invoice is not addressed to you. So this is very common in a situation where, let's say, you reimburse your employee or M1, right? And because he's the subscriber, you're not going to get a tax invoice from these mobile phone companies. So as a result, right, you theoretically cannot claim any input GST because the tax invoice issued to, let's say, Mr. Lim, and Mr. Lim is not GST registered, right? So the concession here is if there's certain supply of fringe benefit that is provided in your employee's name, you could claim an input credit even though your name is not on the tax invoice, subject to the conditions here. So this is first part of the administrative concession. So the other part is this closed nexus test. So I think the more relevant question you have with respect to the closed nexus test is why is one not because the pantry supplies are allowed as an admin concession under the fringe benefit? As I look back at the question, okay, let's see. So it would say that the closed nexus test applies in the case of input GST for the pantry snack and soft drink for staff. Well, I would say that it's not the closed nexus test, right? Because if you clearly apply the closed nexus test, then you may not be able to claim the credit. Because if you look at the closed nexus test, which is prescribed here, okay, you say that you must have incurred GST on the provision of fringe benefit if it's only for the purpose of your business. So I would say that the pantry, okay, office pantry is slightly different from the example given here, which is for the purpose of your business. So for example, right, the example that they gave is really, this directly maintain or increase efficiency of business operations. For example, provision of meal in the course of business meeting. So are you thinking about utilizing this part of the indicator? Ming Yao, or which component are you thinking about? Because I would think that it's technically under staff welfare, so we should not have an issue with GST. There's no need to apply the closed nexus test. Have I clarified your question, Ming Yao, or you'd like to come off mute if I haven't? Seven point 1.2. Okay, let's look at that. 7.1.2 or 7.12. Let me read again. No worries. I could read the chat. It's fine. Yeah, I think that's one way to look at it. Because if you look at this, I would say that it's an admin concession rather than a closed nexus test. So there's a difference between the two, right? Because if you're talking about the closed nexus test, they give multiple scenario as general rule and what the test is, which is all up here. But 7 is a different one. 7, they say you disregard the closed nexus test, they are going to give you an administrative concession. So the closed nexus test and admin concession is actually two different things. If I were to apply the closed admin concession strictly, you may end up not being able to directly map the pantry because it's not a business lunch, right? But admin concession actually waive the closed business test. So if you look at the way this question is framed, they say that you apply the closed nexus test, which is not correct. So if I want to really make this an accurate statement, I would say that IRAS administrative concessions allow for input GST for office pantries and snack, and that's what you refer me to, which is 7.12. Okay? Clear? Okay, good. Thanks for the question. Let's move on. Okay, now I have the second question for Chezhong. Are CA's donation Section 40N and unutilized items deductible against non-trade income and employment income? So I think this is more, you're thinking about employment income is more from an individual or business perspective, right? So if you look at the ultimate preparation of the individual income tax computation, you are first required to identify the source by source, and then in general, what will be deductible against all source of income, right? It's really more your trade losses only. So CAs and I think donation, yes. Trade losses, yes. 14N and CAs are more deductible against your business profit segment of your individual income. But if you're talking about a company, right, then it's technically deductible against all your other income. So for example, the company may have their main business income, and a company may get interest income. Okay, it doesn't mean that just because the company has interest income, you cannot deduct your unutilized business losses for the current year against your interest income. It is possible. Okay, I I hope I have answered your question. Zhezhong? Okay, great. So now I think we got time. I would like to open up the mic or the chat. For those of you who have mic issues, not a problem. Any areas or question you may have for me? Okay. Okay, while I allow time for some of you to input suggestions and questions, maybe what I will do is let me go through this, which is a page on the study guide. And I thought that this is very interesting because when we look at the module at a glance, right, what exactly they require you to do, this will be a good starting point for those who are still trying to figure out how to revise. Okay, it's actually not going to be easy, I know, because income tax is very broad, and you guys are not dealing with just income tax. You guys are dealing with income tax and GST. So against this very broad topic, how do you instill structure and then identify the areas or that you need to revise, right? So let's look at, first of all, what are these? I would call these 6 primary indicators of your understanding. Okay, A, you are expected to explain the original function and purpose of taxation system in the Singapore economy, identifying different types of taxes, principal source of revenue law and practice. So I think the first one is more testing you on your knowledge on what's the difference between income tax and GST, right? By the name, you will know that income tax taxes someone's income, be it corporate or individual. Therefore, you must have an income before you can be taxed, right? And Singapore tax system only taxes revenue gains or revenue income. Capital gains are not taxed. On the other hand, GST is a transactional tax, okay? And because of it being a transactional tax, there are people who say that it is actually benefiting the rich more than the poor. This is because as long as you consume, you pay the tax. It doesn't matter your income, your status, right? So today, if I go to a bubble tea shop in Singapore, I buy bubble tea. If the bubble tea is GST registered, they will charge me 9% GST. It doesn't matter when my money income is 1,000, 10,000, or 100,000, I still have to pay the 9%. Income tax is slightly different. If I'm actually a lower income worker, or because of the fact of a progressive tax regime, I do not earn a lot, I don't hit the higher tax rate, I do not pay as much tax as a person who is high income earner or a wealthy businessman. Okay, so you need to differentiate between the purpose of these 2 types of tax regime and how different it is when you apply it. Transactional basis vis-a-vis income based. Okay. B, define the scope of individual income tax for residents and non-residents and understand the various type of income and demonstrate how they are taxed. So when we look at individual income tax, there's really 2 components. One is to understand the income. Second is to understand the relief and deductions. So on the income side, clearly the biggest thing we need to understand is differentiating tax resident and non-tax resident. Okay, this concept is not to be mixed up with citizen. Okay, now citizen may be a tax relief requirement. For example, qualifying child relief require the child to be a Singapore citizen. Okay, but when we talk about tax resident, it's different from nationality. So general rule of thumb, you should remember anybody who is physically in Singapore for 183 days is a tax resident. You could be a US citizen, but if you stay here for 183 days, you become a tax resident of Singapore. Okay, and the difference between a tax resident and a tax non-resident, let's not talk about from a relief perspective first. The first thing you need to know is non-resident for employment income. Section 14B impose a higher of 15% flat rate or resident progressive tax rate. That would be the main concept under B. Okay, in addition, you need to familiarize yourself with the types of income that individual could be earning. And if you look at past exam questions, the individual usually have employment income, sometimes have rental income, interest income, or partnership income. Okay. For individual perspective, because for MCQ related questions, you're not required to deal with computation on a source by source, but you need to understand that when I calculate my income, I usually go source by source. I deduct the relevant expense against the relevant income. So for example, I deduct any employment related expense with my employment income. Okay, that will be B. C, compute an individual's income tax liability taking into account of personal relief. Okay, and to revise personal relief, I'm going to post this to the chat so that all of you could bookmark it. There's no better place to look at personal relief, okay, other than the IRAS website. So at a glance, okay, for Singapore tax resident, you will consider the following relief, okay? So this is where I would suggest you revise, and as a starting point, take down all the possible relief for an individual. If you click into it, you will see the relevant conditions. For example, if I click into spouse relief, okay, and then you can read, oh, so to claim spouse relief, your spouse must be living supported by you, did not have an annual income more than 8,000. Okay, these are the conditions. But here is a good summary page. So when you do revision, right, or when you actually look at creating your cheat sheet, which I understand from Laksha that you're able to create, right, you will need to match this against what's Appendix A. Make sure that you don't duplicate, and then try and note down a reminder for you. When you look at the questions, as you can see, some of the sample questions ask about, other than those mentioned relief, what are the other relief available? Okay, so this will be a good reference point for you on the relief. Once you are able to once you're able to match income and relief, you will be able to get to a situation where you can compute the individual's income tax liability. Okay, so that's C. D, define the scope of tax, profit chargeable to corporate income tax, and understand the concepts of tax deduction and capital allowance. So this sounds like a very simple statement, but incorporates many things. So first, you need to understand the scope of tax, meaning when does a company bring its revenue to tax? So you first need to understand Singapore source income, okay, and foreign source income. Singapore source income tax on an accrual basis, you disregard remittance, you disregard payment received. Foreign source income will be remitted into Singapore on what? On a remittance basis. So you then need to understand when you talk about remittance, what's actual remittance and what's deemed remittance. Actual remittance is very simple. Cash come in Singapore, received in bank account in Singapore, actual remittance. Deemed remittance means that the cash did not come in its actual form, but other things happen, such as you purchase a movable property, you bring it to Singapore. Or you use the money to pay a supplier in relation to your Singapore operations. Okay, those will be the situation of deemed remittance. So you need to understand this. So that's the scope of tax. Then for foreign income, you also need to understand FSIE, Foreign Source Income Exemption, which is Section 13(8) of the Income Tax Act. Okay, and that means that if you have foreign source income, it could be exempted provided that the conditions under Section 13(9) are met. Okay, that also falls into the scope of tax and profits chargeable to corporate income tax. On the second half, you need to understand the concept of tax deduction and capital allowance. So tax deduction and capital allowance are two separate things. So to understand tax deduction, you need to first remember that Singapore does not tax capital gains. It only tax revenue gains. Therefore, on the deduction side, you will need to remember Section 14(1) and Section 15. Section 14(1) states that you can deduct any revenue expense incurred in the production of taxable income and not prohibited by Section 15. So these two has to read together. Okay? When the question gives you a type of expense, ask yourself, is this incurred in the production of taxable income? Yes. Is it revenue in nature? Yes. Is it prohibited under Section 15? No. Then you can claim a deduction. I don't think there's an expectation for you to memorize all the prohibition under Section 15. Okay, but I expect that you remember the common ones, such as fines and penalties. It's always blocked under Section 15. S-plate car-related expenses, petrol, parking, mileage, all prohibited under Section 15. Anything that's capital in nature, also prohibited under Section 15. Okay, just have to know the common one. And other than tax deduction, another thing that reduces one's taxable income is capital allowance. Remember, we talk about capital allowance, it has to be given to plant and machinery only. Okay, so for capital allowance category, given that IBA has long been phased out, like I mentioned, I do not think they will ask you to calculate IBA. And land intensification allowance is on an application and approval only basis. What's left is understanding the general capital allowance rules, which is Section 19 and Section 19A. So Section 19 simply means that you will deduct your capital allowance based on what we call the 6th schedule useful life. Okay, and for those of you who have not seen before, let me try and see if I can pull out the IRAS 6th schedule for you. Okay, I'm not sure how many of you seen this, but as a tax practitioner, I used to come here quite often. So what you are looking on my screen is actually the 6th schedule. Okay, 6th schedule effectively is a prescribed list of equipment and their relevant useful life. Okay, for example, if I buy I think it's a bit too crazy to say aircraft, okay? Fire safety device, okay, which is very common if you install a sprinkler, for example, or fire hydrant in your building. Fire safety device, you're supposed to deduct over 10 years. That's the prescribed useful life under Section 19. Okay, this is one alternative. The other alternative is Section 19A. So Section 19 capital A provides capital allowance deduction over only 2 time period, 1 year or 3 years. Okay, 1 year is provided to small equipment, any small office furniture or plant and machinery lesser than 5,000 individually, accumulatively not more than 30,000, and automated equipment such as computer, laptop servers, they all qualify for 1 year. If not, if it fall outside these two, it goes into a standard 3 year, which is 19A. So the good thing about this is that you don't have to go and refer to 6th schedule, you don't have to memorize it. I honestly do not think that the purpose of the exam is to ask you what is the working life of an aircraft under the 6th schedule. Okay, what you need to take note is in the question itself, look for hints like greatest capital allowance over the tax time period. Okay, usually this happens because if they tell you greatest time period and you look at the 6th schedule, I assure you that nothing is 1 or 3. Everything there looks like it's 10, 8, 6, 12, 15, 20 years even. So very likely when they want to claim the maximum allowance, they will go for 19A, which is either 1 year or 3 years. Okay, so nothing too worrying under capital allowance. The only other special deduction is Section 14N for renovation and refurbishment. You need to note that there is a 3-year, 300,000 cap, and the 3-year is prescribed. YA 25, 26, 27 is 1 year, 28, 29, 30 is another 3-year period. Okay, and within the 3-year period, you can claim a maximum of 300,000. And take note, the amount is not to be claimed over 1 year. The amount you claim in any of the year is to be divided by 3. So Section 14N also needs to be claimed over 3 years. Okay, pause here. So far, A, B, C, D, any question? Any areas you want me to double down on? Nope. Okay, next E, compute corporate taxable income and income tax liability, taking into account group structures and general partnership. So again, these are very two distinct things, right? Group structures and general partnership. So general partnership itself is not a taxable vehicle. You cannot tax a partnership, meaning you need to tax the partners of a partnership. So what the partnership needs to do is to ensure that annually, the managing partner will need to file Form P to inform IRAS what is the amount of income attributable to each partner. Now, it is also important to note that this amount income attributable can be totally negotiated among the partners. There's no prescribed percentage you must be. You want to do 99 to 1, you want to do 90 to 10, 50-50. It's all commercially negotiated between the partners. Okay. You must also note that this agreed profit sharing ratio is also the agreed loss sharing ratio because it cuts both ways. Okay, it doesn't mean that you only share the profit. You will also need to attribute the losses to each of the partners. It is not uncommon for a general partnership to be consist of corporations and individuals, and therefore whatever profit and loss will be dealt with in its own individual income tax computation or corporate tax computation respectively. And that's about it for general partnership. For group structure, you need to understand group relief. Basically, members of the same group transferring current year loss items to each other. Okay, take note, only current year loss item. Okay, in addition, for a company itself, you need to understand in the year where there's excess expenses or excess capital allowance, leading to an unutilized tax loss or unutilized capital allowance situation, it can be carried forward indefinitely in the future years. It doesn't expire as long as the condition when you need to claim is met. Okay, so unlike certain countries, Singapore doesn't put an expiry date on the unabsorbed loss items. It's indefinitely carried forward. It can be utilized as long as in the year that you seek to utilize it, you pass the relevant test, which is the same trade test and the change in shareholding test for unutilized capital allowance, and only the change in shareholding test for unutilized trade losses. Okay, that would broadly be the things you need to know under E. Last but not least, we now move on to the other transactional tax, which is F. Define the scope of goods and services tax, explain the basic workings as well as compute GST return. So the basic you need to know is that the amount that you need to pay the IRAS in the GST return is a result of your output tax minus your input tax. So what is output tax? Output tax is the GST that you charged as a GST registered business, and input tax is all the GST that you have paid, okay, and supported by valid tax invoice and not prohibited under Regulation 26 and 27. Okay, so if your output is bigger than input, you need to top up the amount to IRAS. If your input is bigger than your output, not impossible. You can then claim a refund of the excess input tax from the inland revenue. So under the GST concept, other than just this output and input, you also need to understand the nuance of one, what is a taxable supply versus a non-taxable supply, or non-taxable supply can be broadly classified as exempt and out of scope. The impact is different because if you are making excessive exempt supply, you may need to apportion your input tax. Okay. In addition to that, Regulation 26 and 27 are critical. You need to also understand what are the common deduction, common blocked input tax under Regulation 26 and 27. Conceptually, this is a standalone legislation. You do not refer to the income tax regime to look at Section 15 for deduction. They are totally two separate legislation. Then the other uniqueness of GST is really what we call the reverse charge. It was recently introduced, not more than 4 to 5 years, where a GST registered business, when they purchase services from an offshore vendor, offshore meaning foreign vendor, you need to account for reverse charge. So GST reverse charge is not a cost. You will see that you account for output tax and on the same return, you claim the same amount as input tax. It's a net zero position, but you're still required to account for this GST under reverse charge to ensure compliance. The other concept that came up in the mock question is the concept of transfer of business on a going concern. So if you are a GST registered entity, be it sole proprietor or company, when you actually sell your business or transfer your business, you are required to charge GST unless the exemption applies. And the exemption applies is what we call the TOGC exemption, transfer of business on a going concern basis. And if that condition is met, you will not need to charge GST to the buyer of your business. And this is really useful for companies that are doing restructuring and doing entire business transfer. Okay, so effectively, I think these are some of the more common GST concepts that I can think of. And fulfilling this A to F, I would say, key points of our Singapore Foundation Program taxation module. After going through all this, any questions? No? Okay, if not, I think I will take the last 5 to 10 minutes to broadly share my observation of the sample questions with you. So if I go back to the sample questions that we have gone through so far, right, over the last 2 sessions, the other thing that I want to highlight is that while the syllabus actually maps out, okay, the questions into different categories and wants you to focus on them separately, the questions have shown examples of how they could actually mirror the two concepts together and test you, right? So you need to be aware that in the MCQ question, exam format, right, based on the pilot paper shared by ISCA, is slightly different from the long answered question format. For the long answer question format, typically we can predict the 3 questions and one what I call wildcard. There will be one question on individual tax, ask you to prepare a computation. There will be one question on corporate tax, again asking you to prepare computation. There will be one question on GST, asking you to prepare input-output tax, computing the GST of a transaction of business. And then the fourth one could be, it's, I won't say random, but it's always circulating between group relief, partnership, or unabsorbed loss questions. So that was the previous format. Okay. Now it has morphed into an MCQ format. Now the good thing about MCQ is that you have 25% chance of getting every question correct. So for extremely lucky people, you probably could get full marks even though you do not know everything. But the downside to that is that it blurs the line, right? As you can see, we have tried to characterize the question into different categories. However, some of the questions cannot be squarely be fitted into one category because they could ask about, let's say, withholding tax question in both individual tax and corporate tax, right? So for example, if they want to ask about whether or not withholding tax is applicable. So in general, you learn withholding tax under section 12.7 and 12.6, which is income tax, right? And you associate it mostly with corporate tax. But it could be mashed up with an individual tax question to say that, well, if I have a certain expense payment to a Singapore branch, is it subject to withholding? Okay, that will be one way to think about the questions. Next, you need to think about the questions and read them very carefully. Even myself, as I go through the questions, I flip-flop between incorrect, correct, incorrect, correct. And then at the 10th question, sometimes I ask myself, am I hallucinating? Because I have to read the question 3 times. Sometimes they say which of the 4 statements are incorrect. Sometimes which of the 4 statements are untrue. So you have to be very careful with this kind of lingo. Okay. And when you are asked to assess the validity, the accuracy of a statement, you could land up in a situation where more than one of them sounds like the correct answer. Okay, and this is evident in today, the question they went through in 38. Okay, so you have to be very careful when you assess the question, because if the question appears sweeping, such as is never deductible or is always higher applying a certain method, the fact that you use a very sweeping word should put you on alert that you need to consider the sentence very carefully. Okay, there could also be a situation like this question 38. This is a classic question that people actually asked me before in the other sessions I've conducted. Between A and C, they think both are possible answers. Okay, and my observation is also that yes, both are actually possible tax treatments, because both of them encompass the concept that if no deduction has been claimed, I should not be taxed on the recovery. If a deduction has been claimed, I should bring it to tax. A and C, both options actually contain the spirit of this tax concept. Okay, but why A became the final answer is because the way that the question is framed asks about which statement best describes the insurance payout and possible deduction. It's not a question that asks you which is true and which is false, right? So this is a very good example why I want to highlight that in the event that during the exam, you end up with two possible answers in a question like this, reread the question again. What is the aim of the question? Is it asking you to assess the truth or false of a statement, which is absolute? Or in this case, I'm not talking about absolute. I'm finding one that best describes how a taxpayer should react in this situation. And therefore, going back to the two options, I will pick one that is the very technically and academically correct answer. Going back to revise my tax return now that I have additional facts regarding a deduction that I didn't claim before. And because I claim a deduction, I need to bring it to tax. Okay. So I think it's all about exam techniques, reading the question slowly and carefully, and able to distill between what are the correct statements and incorrect statements based on the way it is framed. Okay, I think it's not difficult. It just requires a different mindset, right? So when you read the past year exam questions, I know some of you are using the past year long answered questions as a test bed. It is a good starting point. And in fact, those examples are likely to come out as a very long case fact questions in the upcoming MCQ, because as you can see from some of the questions, like question 30 to 37, okay, this is a format that in the past you will see is given. And then the next question come up is compute or prepare the tax compilation for SPL for YA 2025. Okay, and then you have to put all this in the standard format. Given as an MCQ, they're not going to ask you immediately to compute everything. They're going to ask a mix of technical questions and computation. So looking at using the past year exam questions and gauge yourself. If a question come out like this and they ask me about the taxability of, let's say, this interest income, am I able to address it? That will be a good way to revise and prepare for the MCQ. Okay. Can I ask about no more cost relief claim from this year onwards? Yes. Jin Jing, I believe. What do you want to understand about cost relief? Right? Are you coming on mute? Give me a second. Okay. So I'm gonna put this into the chat too, because I think I have a question in relation. If I pay for my own cost this year, can I still claim? Okay, very good. So if you look at what the IRS says, you can cost relief is discontinued from YA 2026. The final year that you can claim is in YA 2025. Therefore, this year is YA 2026. you cannot actually claim any more cost relief. You can only claim it if it is in your YA 2025 tax return in year FY 2024. Okay? Questions? Yeah, I mean, the IRS phased out quite a number of these relief. It's not the only one. Please remember the foreign domestic worker levy relief has also been phased out, and there are changes to the working mother child relief. Okay, but those may not be applied to, I think, YA25. Some of them for YA25, some of them, yeah, YA25 should be affected. For the working mother child relief, it depended on the age of your child. So, okay, I think, let me see, is there any other questions I should be addressing? I think Laksha addressed the question of where the Excel sheet is. Okay. With that, I think we have reached the end of today's session. Any last minute questions or areas that you want me to talk about before I call it a day for everyone? Nope. All right, if not, thank you for spending your Friday evening with me. I know that talking about tax is probably not the most exciting way to end your Friday evening, but I'm glad that we stick through the 2 hours, and all the best for your upcoming examinations. I hope all of you could pass with flying colors. Thank you very much.
The recording has stopped.